when it comes to really looking for these investors, usually you already have some investors from your pre-seed or seed round if you raised money before. Then the question is sort of, should you try to get the same investors on board with higher tickets? I know that's not always possible. Or should you always also start looking for new investors? What sort of the best mix that you see in the market there? Is it a mix of both? Is it just bringing new investors on board? What is your take there?
Well, if you can get your current investors to invest again, obviously that's very good signaling again. Also, as Kai said, because it shows to any other investors that the guys that have more insight into what your company is doing still believe that this company has growth ahead. But realistically, a lot of the first investors will not have, as you also mentioned, the cash in their pockets to go and fund this next bigger round. And I also think it's not good to only have those, because what you want to do is you want to start growing your investors pool, not extensively, but with certain people that are, or certain funds that are actually really well known on the market for that kind of investments, and can also help you then found the next round after that if you need one, either themselves or by having very good relationships to those next investors because they've been doing deals together on and on and on, which then reduces the stress a little bit on you as a founder to go out and find all of those next round investors. So I think it should be a mix. It should be signaling from the old investors that they're willing to participate again, but you should always bring in one or two big ones that really have that kind of professionalism, that expertise in this new stage of your company, that can take you to the next round. Because you also always have to think of the next round after that, right? So you should also have that in mind and be prepared to onboard the right investors.
It never stops. Let's look at the real example with Oviva, Kai. Is that exactly how you did it? A mix of new and existing investors participating as well?
Yeah, I think we're very lucky that already from the start we brought on, mostly at least, uh, investors that have almost an evergreen approach and have continued funds, significant continued funds to invest. And I think it's something to really look for. Most, I say, professional venture funds, and again the range is huge, have, they make the initial investment, but then they'll keep in reserves, like I think the industry average is again the same amount for follow-on investments, which they then distribute across the portfolio companies. It doesn't mean you'll get that specifically, but they'll distribute that among their portfolio companies. And many other funds cannot invest from their future funds again, right? So they couldn't just raise another fund and then invest again. So even if they love you, often just due to how they raise the next round, they don't have that ability to reinvest into it. So you will then quickly tap out on those investors in terms of how much they can continue to invest. But luckily, we've had many investors who could continue to from the Series A through the Series C and still can continue to invest now. And that's really helpful because what they typically do is they invest at pro rata. So what that means is, that's kind of the standard, is like that's their share of the company. So if, let's say, they own 10% of the company from the Series A, they'll continue to take 10% of the next round, and you have to raise 10% less. So that just increases your ability to fundraise, and that signaling value, as you suggested as well, is really important too, that they continue to do so. So it can work against you as well.
What is a good storyline that really attracts investor in that sense? What are some good milestones to share in that sense? Is it users? Is it revenue? What is it that really appeals?
Yeah, I think that the general evolution from founding, seed, Series A, B, C, D, et cetera, it's just as the company matures, it evolves from kind of the dream, the idea, and the founding team, which is really what it's about in the initial stages, to more and more financial metrics, and more proof points around product market fit, but also your customers. You'll have a lot more customers at a Series B or Series C, which people will just expect to see a certain repetition in those. You won't be able to raise a Series B or C on one customer typically. You'll need to have a large, scalable market proof, and you'll be looking more and more of those aspects. And I think one of the most important aspects that we learned over, I guess in particular for the Series C, is just how important, for instance, recurringness of your revenues and the recurringness of the business base really becomes over time. Initially, that's not so important. It's become more important over time as well. But I think that's really then the basis where people can see, like, yes, this, from the numbers and from the number of customers out there that you can still address, this can become a huge business. and that's what it ever more becomes about.
Maybe I can add there, Kai, what I saw, and I thought that was a very interesting LinkedIn post. There was someone, a VC, that said, typically the further on in the investments round you are, the further back in the deck the team slide goes. You basically, in the beginning, the team slide is very prominent if you're a bit ballsy about what you can do as a team, and then it starts going back. And the other way around, the further on you are with investment rounds, the more in the front of the deck you will have all the financials popping up, right? Because as Kai said, this is starting to become more measurable, more quantifiable, and if you're doing well, more of a success factor that you can sell to investors as well, right? So I found that very interesting to see how this moves throughout the deck usually.
It also has to do with exit, right? I mean, as you go down the alphabet of your fundraisers, you also move, and you're VC funded, right? Who will want an exit at some point. The financial metrics will be front and center. If you want to do an IPO, your team is much less of an argument than the financial performance of the firm, which will be analyzed through and through by analysts all around the world, right? So, indeed, I think the closer you come to an exit, especially if it's a public market exit, I think the whole thing gets quite unromantic compared to earlier rounds, where you're also selling, a future and to a certain extent buying into the potential of a market.